tariffs on U.S. imports.
Trade war with the US.
Recession, trade war, escalating tariffs. Have you ever gone on a roller coaster where you were blindfolded? Yeah, me neither. But watching the stock market the past few weeks sure feels that way. One minute you're climbing, the next your stomach's in your throat. Volatility, trade wars, recession fears. Literally, the buzzwords are saturated in the news cycle. It makes sense that we all feel a little jittery right now. In this video, we will explore practical investment strategies and specific sectors that have historically shown resilience during economic downturns, where I'll provide a comparison of these sectors, some specific stocks and ETFs, and I'll also throw in some gold to give you a broad view. This should provide you actionable insights that you can use, or in the least, help you research it further. Here's the thing. You've worked hard for your 401k, and the big question that everyone is asking is, where do you safely invest when the economic powerhouses are battling it out? Nobody knows how this current situation is going to pan out, and we still have those 90 days to stay on this same roller coaster due to most all of those tariffs being put on pause. A recession freezes spending. It slows growth. And I think we all understand that a tariff war throws wrenches into global supply chains. And I'm guessing that a lot of you haven't experienced many market pullbacks like this before. And you may not have been psychologically prepared to take those kinds of losses, which means that some of you may want to be slightly defensive with your investments. And that's exactly what I'm going to cover. All right, let's cut through the noise. Panicking is not a strategy. Adapting and creating a plan, well, that's the right thing to do. During times like these, certain assets historically act like safety rafts on a sinking ship. My first job out of college was with Albertsons Corporate, which is a grocery chain, and we were entering the 2007 recession. My boss at the time put it in the most blunt of terms. He said, people can't live without their food, their liquor, and their cigarettes. And he nailed it. Those categories blew up in growth during the Great Recession. And today, those essentials are becoming way more expensive with inflation. And it creates a forced function of focusing more heavily on our basic needs than ever before. Look, navigating a recession plus a potential trade war isn't simple. There's no magic bullet. It demands a clear head, solid facts, and a strategy tailored to your risk tolerance and your timeline. Forget trying to time the bottom. Focus on building a resilient portfolio that can weather the storm. For me, I'm young enough that I have a larger risk tolerance and I'm willing to have more in the growth sector in areas like technology. But this is about you and your risk tolerance. Now, the word recession sounds heavy, and I get it. But let's put it into perspective. It's not the economic apocalypse. The official definition of a recession is 2 quarters of declining gross domestic product. These things are actually a normal part of the cycle, like seasons changing. Since the dust settled after World War II, the US has seen a recession roughly every 6 years on average. Yeah, they've gotten a bit less frequent lately, meaning we've had some really long stretches of growth. The longest was over 10 years. But that just means that many individuals haven't ridden this part of the roller coaster yet, making it feel a little bit scarier when it does happen. The average recession lasts about 10 months, though some are shorter, like the blink and you missed it dip in 2020, and others linger, like that 18-month-long slog from 2007 to 2009. Quickly, let's recap the playbook. Recessions are normal. Markets dip, sometimes hard, but they always recover eventually. Market timing is a fool's errand. So, what's the smart move? You plan ahead. By creating a plan, we're still on that roller coaster, but at least we've taken off the blindfold. And when things go south, it's going to be in our nature to go into that fight or flight mode. But having a plan will help us reduce that stressful shock. Because having your investment strategy locked down before the storm hits, it acts as your anchor. It keeps you from making those knee-jerk reactions, like dumping everything when the prices start tanking. I don't know, it's like changing out your smoke detector batteries every spring. Preparation gives you a little bit of peace of mind. And some things that you can do to provide yourself a little bit more peace of mind are plan your investments around the market cycle. Meaning, we know that we have a recession roughly every 6 years. And if we've gone 5 years with a lot of growth, then ensure you have some defensive investments if you have a lower risk tolerance. Next, mentally prepare yourself for market losses. The market is an organic beast because it grows and it retracts based on human interaction and behavior. It has standard seasons, and it can't be summer all the time. We need a solid winter for new growth. Lastly, avoid constant monitoring. If you have a plan in place, and if you have expectations of a market winter, then don't kill yourself by constantly checking the markets. Literally, you will kill yourself with anxiety. Let's go a little deeper into the part of planning, which involves understanding that not all businesses get hit the same way. Those fancy restaurants or airlines, they boom when times are good, but they suffer the most when people start to cut back. But then you have the defensive players. Now think about it. Even if money's tight, you're still buying groceries, toothpaste, diapers. You're keeping the lights on, and you're getting medicine if you need it, right? Companies providing these essentials, think consumer staples, healthcare, utilities, they tend to have steadier demand. The revenues are more predictable, even when the broader economy is shaky. They may not give you those eye-popping growth numbers that you see elsewhere, but they offer stability when the waves get a little bit choppy. Building a portfolio that includes these sturdy players can really help you ride out the storm. In researching for this video, these three sectors constantly stood out as being resilient during past recessions, and that's in comparison to the S&P 500, where you can see that in all cases, the consumer staples sector outperformed all others during the dot-com bust, the Great Recession, COVID, and also the bear market of 2022. And you can see how healthcare and utilities also did during these exact same times, which was better than all other sectors. And so let's dive a little deeper and look at consumer staples. Think household necessities, toothpaste, toilet paper, diapers, soap, and basic food items. Stuff that people buy consistently. Big names often dominate here. Companies like Procter & Gamble, making everything from Tide to Crest, or maybe Coca-Cola or even PepsiCo. Because demand stays relatively steady, these companies often weather economic storms better than, say, an imported car with those high tariffs. Now, if you're someone who prefers broader exposure without picking individual stocks, then we have ETFs like the Consumer Staples Select Sector SPDR Fund, or the Vanguard Consumer Staples ETF that track this sector. And here's how each of these assets performed during the past pullbacks. They all seem decent, but Walmart looks to shine the brightest. I want to point out that I chose specific dates when I ran this analysis. The companies and the funds had lower drops at their worst point, but to keep every company and the fund as equal as possible in my comparison, I used these exact dates every time for an easier comparison. And if you've seen any of my prior videos, then you know that I'll provide a recap at the end, giving you very specifics as to how each of these stocks and ETFs compare during past recessions. And if you appreciate my style and the information that I'm sharing, I would truly appreciate your support with a like and a subscribe. Now let's move on to healthcare, and this one's pretty intuitive. People prioritize their health regardless of economic conditions. That includes pharmaceuticals, medical devices, health insurance, and healthcare providers. Think giants like Johnson & Johnson, that's involved in everything from pharmaceuticals to medical devices, or large health insurers. Again, for diversification, look at ETFs like the Healthcare Select Sector SPDR Fund or the Vanguard Healthcare ETF. These bundle together many of the top companies in the sector that have a proven track record. And here's how each of these assets performed during the past pullbacks as well. Johnson & Johnson was the best within this grouping that I'd pulled randomly, and you can also see that the ETF for the healthcare were better than the S&P 500. Next is utilities. We all need to keep the lights on, heat our homes, and have running water. Utility companies are the definition of essential, often operating in regulated markets, which can lead to more predictable revenues and often steady dividends. Think of major power companies like NextEra Energy, which is also a leader in renewable energy as well. And ETFs tracking this space include the Utility Select Sector SPDR Fund and the Vanguard Utilities ETF. And here's how each of these assets performed during the past, where it was not nearly as good as healthcare and definitely not as good as consumer staples. Clearly an improvement on the S&P 500, but it's also the lesser of the three. And stay tuned as I compare all these with gold and some other big companies at the end. Remember, Investing in these sectors isn't about guaranteeing profits during a downturn, but historically, they've shown more resilience. They provide a potential buffer when more cyclical parts of the market are getting hammered. In addition, all three sectors are heavily domestic, meaning that many companies in these sectors have less impact from foreign imports that could be impacted from long-term tariffs. Now, what about gold? You always hear about gold during uncertain times. It's often called a safe haven asset. The idea is that while currencies or stock might fluctuate wildly, gold holds intrinsic value. For centuries, it's been seen as a store of wealth. But does it always go up when the market goes down? Well, not perfectly. History shows it's a little bit more complex than that. But during periods of high inflation, geopolitical stress, or significant market fear, investors often rush to buy gold, which can obviously push up its price. It tends to hold its value better than paper assets when confidence is shaky, like what we're seeing today. Granted, owning physical gold bars can be a little bit challenging. You've got storage, insurance, and overall it's a hassle. For most investors, getting exposure is easier through ETFs that track the gold price. And two of the biggest are SPDR Gold Shares and the iShares Gold Trust. These essentially let you invest in gold without needing a literal vault in your basement. In simple terms, gold is a limited resource where we can't produce more, so it has lasting power, while all other investments in companies, well, they can fail. Now let's take a moment to review how all these stocks and sectors performed during all of these market pullbacks. And just for fun, I added in Berkshire Hathaway, Costco, and some oil companies, and also a few tech companies, so you can see how they all performed during these market downturns. Keep in mind, a big picture that I am not showing is how they did when they corrected and recovered. But to keep this simple, I'm just showing this one view. And the one stock that stood out better than all the others consistently was Walmart. They had the least reaction compared to all the others. And it's no surprise since Walmart is known for their low prices. And that's what everyone needs during these bad times. Resources that are not renewable tend to hold their value. And I will have a link to this spreadsheet down in the description so you can look at it all on your own time. Look, investing during uncertain times isn't about predicting the future. It's about preparing for different possibilities. Understand the cycles. Stick to your plan. Diversify wisely across sectors, including those defensive players, and consider assets like gold as part of your strategy. And as I always say, focus on the long game. That's how you navigate the inevitable dips and you stay on track. And everyone's risk tolerance and time horizon is different. Invest in a way that makes the most sense for you. And whether you choose to have some form of defensive stance or none at all, it's entirely up to you. And this video outlines the areas, the funds, and the assets that have historically done the best in market pullbacks. What you do with that information is completely up to you. In either case, I hope that you found this helpful. And as always, thank you for watching.